Alright students, we're going to go through Investing 101 today. We're going to start with the purchase of a stock. Remember, as we talked in class, when you purchase stock, you're actually becoming an owner of the company. You're actually purchasing shares, also known as stock of that company, so you will share in all the profits or losses that that company makes in a given period of time. Companies will often issue stock in order to help their company expand if they need extra revenue or assets or capital to expand. They'll do this by issuing an IPO or initial public offering in order to expand their company and hopefully attract new investors. Making money in the stock market is not a sure thing. The only way you can actually make money is there's one or two ways. The way we're going to make money in our project is through capital gains. The only way you can do this is if you buy a stock at a lower value and sell it when it's at a higher value. The other way you can make money off of the stock market is through dividends, and these are just usually quarterly payouts by the company, basically as a thank you for investing in them. So they will give back a portion of their profits to their investors through dividends, and these are basically checks that are sent out to all their shareholders. Stocks can also depreciate in value, meaning that their prices can fall. Sometimes when a stock's value depreciates, there are no profits, so therefore there may be no dividends paid out. A little bit about stock market terminology. First, a stock split. This is used in order to stimulate the purchase of a stock. When the value of a stock gets too high, sometimes companies will issue this in order to make it more attractive for investors to buy more shares. So basically, we went through an example of this in class where if a stock is trading at $100, they'll issue a stock split and take that $100 down to $50 in a 2-to-1 stock split, meaning that if you had, say, 10 shares of that company and they issued that stock split, you would no longer have 10 shares, but you would have 20 shares. Still would have the same amount invested in that company, however. This is good for you as an investor because it will likely encourage new investors to also invest in that particular company, raising the stock value again and making you money. An IPO is another terminology that we need to learn, and this again is called an initial public offering, and this is when a company goes from a private company to a public company and issues shares of stock. A little bit about bear markets and bull markets. If you hear anything about a bear market, that's not a good thing. That's when the market is performing below average. So when you're looking for these things with your stocks, just understand that a high bearish percentage is not a good thing. A bull market, however, is when the market is performing above average. So if your stocks are bullish, that's usually a good thing for you. The 52-week range refers to the highest and the lowest prices that that particular stock sold for in the given year. And so what you might want to do is look at what your 52-week range is and try to buy on the low end of it, and hopefully when you sell it in 3 months or so, you'll be selling on the high end. Yield is a percentage. Yield is the percentage of the company's profit that they give back to investors. And the way this goes back to investors is through dividends. So you're looking for a higher number here, a higher percentage here. However, don't use it as a determining factor as to whether or not you're going to invest in a particular stock. The PE ratio is known as the price to earnings ratio. This is the relationship between the price of the stock or its value and the dividend that it earns. Here you're looking for a smaller number. Basically what it's telling you is how long it will take you to get your money back, your initial investment, that is, through dividends. So some of you may see some pretty high numbers here, 20 or 30, which means it would take 20 or 30 years for you to get your initial investment back through dividends, not through a capital gain. The stock symbol is pretty straightforward. This is just an abbreviation to help you look up your company. There's a couple examples listed here. Volume is the number of shares that are traded on a given day. So you can compare your volume for the day to the average volume, and if the daily volume is a lot higher than the average volume, you know that something is going on, either good or bad, in the company for that particular day. Beta is also a term I'd like you to understand. This measures the volatility of a stock in relationship to the market. If your beta is at 1, what that means is that basically your stock will move in unison with the rest of the market. So if the market tends to trend up, so is your stock. If it's above 1, say a 1.5 to 2, then you're more volatile and your stock's moving around quite a bit. These are the types of stocks you might be looking at for short-term investment. But if you get a beta that's 0.5, that's a much more stable stock. That would be more so for a long-term investment. Yearly target estimates, you'll find this on the summary page as well when you're looking through Yahoo Finance and others. Basically, one of the things you'll see is a 1-year target estimate, and that's just an estimate of what that stock will be trading at 1 year from now. The EPS is the earnings per share, and this tracks basically how much you're going to earn per share in a given year. But you have to remember that all of these terms and all of these equations that we're looking at are all estimates, so it doesn't necessarily mean that this is exactly what's going to happen. A quick look at stock exchanges. The 3 main ones we'll be looking at are the New York Stock Exchange, the American Stock Exchange, and NASDAQ. And if you find a company that's in one of those exchanges, it'll be easy to follow your company's ups and downs throughout the next few months. Think of an exchange as a place where you go to buy and sell shares of stock. It's basically a market. The first of which is the New York Stock Exchange. You'll see your company, if it's traded here, you'll see a little NYSE after its stock symbol on Yahoo Finance and other MSN Moneys, whatever you're using. There's only 1,366 companies that are available to participate in the New York Stock Exchange. You have to meet very rigorous standards to get into this. So the companies that are in here are extremely profitable and very reputable. It's the oldest one of the exchanges. To get a seat, basically you have to issue a lot of money, and you have to be very profitable, and this is just an example. The American Stock Exchange is also located on Wall Street. It's the second largest, just behind the New York Stock Exchange. It deals with a much wider variety of stocks and brokers, and typically will deal with with companies that are in the energy and utility business. NASDAQ is an automated exchange, meaning that anybody can buy and sell stocks from their computer at home. You don't have to have a broker in New York that's making trades for you. They trade online. NASDAQ stands for the National Association of Security Dealers Automated Quotation System, something that you will not have to remember. Just understand that NASDAQ is an exchange where you buy and sell stock online. There are other exchanges worldwide. Internationally, you'll see a number of them. Just be careful if you choose a company that is traded internationally. Sometimes finding your information can be kind of difficult, so I would suggest trying to stay with the New York Stock Exchange, the American Stock Exchange, or NASDAQ. Now, a couple things about indexes. The Dow Jones Industrial Average is a typical index that we will look at to gauge the performance of industrial stocks in America. It's the oldest in America. Today it consists of the top 30 most profitable and widely held public companies in the United States. And so we're talking the most profitable companies that exist here today. And so it just measures how many stocks, how much was bought and sold in these 30 stocks on a given day. And if a higher value is bought in a day than sold in the Dow Jones, or simply known as the Dow, will increase in value. But if less value is bought in a day, then the Dow Jones will decrease. Just think of the index, the Dow Jones, as a type of calculator that mathematically equates how healthy the market was on a particular day. Another index that you will come across is the S&P 500. This basically gauges the top 500 companies on the NYSE. Remember, there's 1,366 of them. They take the top 500 and they average out how they are doing on a given day. And this is probably the best indicator that has such a wide variety from. So it does the exact same thing as the Dow, except it takes